Yeah, okay. So excuse us because like we're late. Matthew's in a meeting right now, so I'm gonna start over with the fun call, and he'll join shortly. So today's Theta Alpha fun call update is on this topic of Trump's tariffs and parallels to draw from last year's. So we'll go over this. After this, we'll go over the summary of outstanding positions, and we'll talk about like how the Theta Alpha Fund is performing and what to look out for in the next few weeks. Yeah, so Trump's tariffs. As you guys know, like in the past couple of days, President Donald Trump has come up with another tariff threat, this time to the EU and to Canada as well. And we wanted to like look back at like what happened with tariffs in 2025 and what were the repercussions to the stock market and like what could be the repercussions now, like because like he started off with these tariff threats again. So, like what happened in 2025 was in February of 2025, Donald Trump imposed 25% tariffs on Canada and Mexico and 10% tariffs on China. And these were like these are the biggest trading partners of the US apart from the EU. So these were the biggest US trading partners around that time. And when these tariffs were like, so in February, like what happened was these tariffs were initially announced only, like they were gonna be implemented or instituted in April. So he like announced as soon as he got elected, he announced that he's gonna like bring tariffs and it's gonna help the budget deficit of the US and it's gonna also give a lot of Americans some windfall money in terms of like paying back some of the taxes that they pay to the government. So these tariffs are going to help with all of those things. So like what happened was he imposed 25% tariffs on the EU as well. However, like what started to happen, and this was not like I don't think it was anticipated. Like what started to happen was these countries started to impose retaliatory tariffs back then. And if you see the average effective tax rate in November of 2025 as a result of all the tariffs that were implemented in by the US on the all the big trading partners was as high as 17%. And this was the highest number since 1935. Previously, it used to be around 2%. So it was like a mammoth increase from like what it used to be. And the interesting part is this thing. The tariffs from January till November brought in around $236 billion. Okay. It sounds a big number, but if you compare it to the overall federal revenue of $4.9 trillion, that was like the revenue in 2024. This is a very minuscule number. Okay. So, like a lot of analysts and a lot of people like who knew the financials or who knew all these numbers came to know that the president's claims that they could replace federal income tax and allow for windfall dividend checks for Americans, there those might not come true. Because like this number is very low as compared to like what the federal revenue is. And this revenue comes from a lot of tax sources mainly, like income tax, corporate taxes, probably corporate tax and income taxes. Those like make up for the most amount of this. The good part, but this is like this is like a bittersweet statement. What happened was the trade deficit did shrank from 136.4 billion to 52.8 billion in September, but it was still higher than the January September 24 number. It was like 17% higher than that. So all in all, these tariffs did not help the overall U.S. economy that and this is like what I've told you. This is from uh, especially from all this economic perspective. We don't know all the other implications. Like there are other implications to this as well, but we are just like talking about from an from purely an economic standpoint of view. This is the recap of the Trump's trade tariffs or actions this like last year, and this is an excerpt taken from like an article back in December of 2025. So it was a roller coaster year, like what the article mentions, and these are the timelines when the tariffs were like basically introduced and implemented. So in between January to March, like Trump, when he came back to office, he focused on like new tariffs basically on the largest trading partners of the US, and those were like Canada, Mexico, and China. And like also the EU, like these tariffs were like announced. They were implemented in April. But like what started to happen was trade wars started to escalate. Like a lot of these countries, like I mentioned before, they started to like reciprocate. They had those retaliatory tariffs introduced against the US. So now, like what started to happen, the president, like I'll go over the next slides and it's mentioned on the next slides, but between May to June, a lot of trade deals started to happen between both. And that is like, that was a relief for the stock market as well. And in August, September, it's the same thing started to happen. But like what started to transpire in September to December was that a lot of people started going to the Supreme Court and there were like cases filed against these tariffs. So like the Supreme Court took the case into consideration and it started to like um, what started to happen was it took this hi Matthew. Yeah, it took the
Right.
case into consideration and now the Supreme Court, the matters with the Supreme Court and it's going to decide like what it's gonna like what decision is it gonna give whether it'll be in favor of these tariffs or not. Okay, so like now, like when we are talking about Trump's tariffs, we are talking about not from an economic standpoint of view, but also like what impact it had on the stock market swings. Okay, so before these tariffs were implemented, the biggest trading partner of the US was China. Okay. So, but it was hit hardest by these tariffs. So now the US tariffs on Chinese imports total around 47.5% as per this Institute of International Economics, Peterson Institute of International Economics. Okay. As a result, the value of goods coming from China fell by 25% during the first 3 quarters of 2025. So this is only the first 3 quarters, like, but the value has shrunk by a big amount during the whole of the last year. The most volatile moments in the stock market coincided when, like, whenever there was a rhetoric coming from Donald Trump regarding these tariffs. Okay, so the volatility in the stock market started to go up. If you see the chart of the S&P or the Nasdaq between February and April, between those two periods, and I have the graphs with me as well. We can like go over the graphs after this. The stock market fell, and that was due to heightened uncertainty as to what will be the impact of these tariffs, what will be the impact of the retaliatory tariffs, and also like whether these tariffs might cause a recession to the US. Okay, because like if there's less amount of goods that are coming into the country and the country is not producing that many goods, like what are the implications? Okay, so volatility in the S&P 500 peaked in April and this was the steepest drop for the S&P 500 in the past 1 or 2 years between February and March, and it started to go up back in June. But we'll go over this like later, like why it started to go up again. The S&P sank almost 5% on April 3rd, marking its worst single day decline since the 2020 COVID crash. It fell another 6% the following day as China's response stoked fears of a retaliatory trade war. So if like the economies basically, Matthew, you would agree with this, the economies basically nowadays function on the fact that there's free trade going around in the world. Okay. So these tariffs essentially they block free trade. And as soon as you block free trade, there are implications. Like every economy would suffer because they'll be having less of those goods and it might ultimately cause a recession.
So
Uh,
I think on that note, guys, sorry I'm a little bit late. I was tied up in another meeting that went a little bit over, so apologies for that. But I think the main thing here is that, tariffs are causing goods to be more expensive. Okay. And the concern is since 2022, we've had, a tremendous amount of inflation. And just when you think that inflation is under control, uh, by the Fed increasing rates, bringing inflation down, we have a new administration that wants to make goods more expensive, basically on a parallel nature by uh, by raising tariffs. And now we have a Fed which is wondering, okay, well, how much is too much to stay? What happens if we don't do anything with rates? What happens if we, reduce rates? Is that going to be offset by higher tariffs? Is that going to cause inflation? And we're back to the same kind of inflation conversation again. Now, an interesting point, I know Danielle had it on another slide. The revenue from tariff. Did you go over the revenue from tariffs versus the
Yeah,
total revenue?
I went
Yeah,
over.
that yeah, exactly. I think that's a very important point to understand here is that yes, did you raise money through tariffs? Yeah, $236 billion dollars. And that's not an insignificant amount of money. But when the total revenue to the US government is 4.9 trillion, you're truly dealing with an immaterial amount of money. Now, granted, the time series here is only about, you know, 2 years, barely 2 years. And that's fair enough. And it's not a lot of time, but this is something we need to keep in mind. So when we see that there's this push-pull reaction to tariffs in terms of is the economy doing better or worse, we do see this in equity prices as well, right? Because equity prices got slammed last April because of the introduction of tariffs. And I would say the introduction of new tariffs and the revitalization of another tariff conversation. Don't get yourself mixed up. Tariffs have been in place for decades, but just not as publicized as now, and perhaps not as stringent as now or as high as now, right?
Yeah, so
So, what's that?
yeah, what I wanted to say was that tariffs have been in place forever, right? But the average
Yes.
effective tax rate in November of 2025 was 17%, which was the highest since 1935. So since free trade and liberalization has been into effect, tariffs have not been this high. And that is what the fear of the people was last year, that this is probably going to bring recession because like they have been like born and brought up in this era of free trade and liberalization. But like this thing brought a different side of different type of fear into their psyche last year.
And now what we're doing, like, you know what, this an interesting question that could come out of this is, well, why are you talking about 2025 when we are almost at the end of 2026? And the reason why we're doing this is that, there's a certain, voice in the investment community that's saying that, listen, this could be simply history repeating itself from last year. And we got a little bit of a hint there, even as recent as 24 or 48 hours ago. The threat of tariffs is still there with respect to Greenland, with respect to Canada trying to broker a deal with China, et cetera, et cetera. That threat of tariffs is still there. And that's what brings some jitters in the equity markets, right? And we do have to always bring this, like, this is a fund update report and not necessarily like an economic advisory report. We have to bring it back to how is this affecting the theta alpha fund, right? And the way this affects the theta alpha fund is that we do need to keep our finger on the pulse of what growth looks like and what the inhibitors of growth could be, right? And right now, again, unfortunately, that is tariffs. We have earnings that just started in earnest, I think today, Danielle, officially last
Yeah.
week. And, from what I read in the headlines, I think Facebook, they did really well. Tesla was a little bit of mixed reaction, but I haven't had a chance to really dive into them. They only came available after the closing bell, which is at 4 o'clock, right? So we do have earnings. Let's just say we have earnings which continue to be positive in nature, comforting in nature. But we do have macroeconomic conditions with respect to inflation, with respect to interest rates and jobs, and now also tariffs that bring a little bit more uncertainty into the picture, right? Okay, I didn't want to backtrack too much, guys. Daniel, where did we leave off here?
Yeah, we were here. Like
Okay,
why the reason that we're going over everything is that we want to like tell everyone that this movie has been like played before as well. Okay, so now like whenever these threats are around, and like when these threats came out, the market, Matthew, you might have like also noticed it did not react that at least till
It
now.
did not. Because
It
you know
did
why?
not
Because
react.
you've seen this movie before,
Yeah,
right? And I think there's, a similar parallel, guys. You could see, uh, remember when, it's very sad, but like when we saw, the Russian Ukraine conflict, right? I'm not going to get political about this because that's everyone's, personal sentiments, but it generally speaking brings a higher level of uncertainty vis-a-vis geopolitical risk, right? Which is very, very hard to hedge against, right? And markets were very jittery for a very long period of time. You had a great superpower in Russia, in conflict with Ukraine, right? And to this day, they still haven't reached a peace deal there, right? And at the very beginning, stock markets reacted to, and they reacted very quickly and sometimes very violently to what good or bad news came out of that region. And slowly but surely, as time passed, though the news from that area no longer impacts the stock market. But I think that took maybe 6 to 9 months, maybe even longer, right? So from that, so we've seen these types of stories that are not necessarily directly correlated with the stock market influence the stock market. And that's what we want to kind of, bring to the table here. Like we do see, a new tariff engagement, a new geopolitical risk here that's revived itself from last year. And we hope like next month we don't have this type of discussion, but this is a discussion that, Danielle and I, as Danielle, Evan should congratulate Danielle. Danielle is also now a portfolio manager on the fund. We're both working on this, and literally on a daily basis, we are discussing, hey, where these things go. Should we move to the next slide here?
yeah. Um, I just wanted to go over this important fact that when he was like instituting these tariffs, and initially it brought a lot of uncertainty in the market, but like he backtracked on everything on April the 9th when the bond market started to like become jittery. So like what happened was then since then he started to negotiate trade deals with a lot of other countries. And I would like to go over this graph, and this graph tells a big like the whole story of like what happened last year. So since his inauguration in like early 2025, he like when he said that he's gonna implement all these tariffs between that date and April the 1st, which was like termed Liberation Day, like when these tariffs were gonna get implemented. The stock market, all it did was fall. Okay, it kept on falling, and even after Liberation Day, it kept on falling. If you see these two graph lines, so one's the red one is the Magnificent Seven, the blue one is the Russell 2000. Like both are indicative of the stock market, like how the stock market behaved. It kept on falling, but it started to rise after April the 9th. And like what happened was Trump started to broker deals with a lot of trading partners. And like what this graph, this is a historic graph. So the reason I'm mentioning it right now is what this graph is telling us is these Trump threats of tariffs, they initially cause a lot of panic in the stock market, but after that, like there's always a deal in place, and the stock market like reacts to that and it starts going up. And this is like what's happened even now. I remember like when Trump like threatened the EU over Greenland, that if like Greenland is not handed over to the US, he's going to implement these tariffs. That day, the stock market did fall by like 1.5%. But immediately after that, at Davos, when he said that there's not going to be, I am not going to like implement tariffs and there's a deal in place, you see the stock market going up and like it's not fallen after that. So it's the same thing that's happened like in the previous year and like in this year as well. So there are a lot of parallels to draw from like what happened last year and what's happening this year. But there's an interesting catch that I'll get over. Like Matthew, if you want to comment something on this, then there's an
Yeah,
interesting
so
catch.
first of all, that's for everyone's knowledge. The Russell 2000 is like a smaller cap index of stocks, and Magnificent Seven, those the broad-based, basically AI and EV stocks, and to name them off the top of my head, Facebook, Nvidia, AMD.
No, Microsoft,
Tesla,
Apple, Tesla.
Microsoft, Apple, and where's the seventh one? I'm forgetting, but yeah, Magnificent Seven. I don't make these names up, guys. That's what the market, as a conglomerate, has decided to name these stocks. And you can see this. You're talking yourself into tariffs from the beginning of the year. You see that angst and uncertainty, and then you have a valley here, and you have some kind of reconciliation that everything is going to be okay, and now you have an uptick in your asset prices. And that's what happened come April. And to those of you who put money into the Theta Alpha fund in at this valley, well, congratulations, you've probably done the best of the investors inside those who invested in 2025. All right, let's go to the next slide.
Yeah, so like this is like what's happening with Trump's tariffs in 2026. So like he announced a 10% tariffs on the EU goods in January 2026, heightening trade tension with Europe. And he said that these tariffs would increase to 25% starting June 2026. But this was the first escalation of tariffs since October. And it could have impacted around, it could impact around 1.5 trillion in trade between the US and the EU. Okay, but like what happened after that, I've just like mentioned it before, like he backfired on everything at Davos because like he said, like there's a deal in place. But the interesting catch right now is that there's a case going on in the Supreme Court that is going to issue a ruling on the legality of Trump's past use of tariff powers. Okay, so that brings a lot of uncertainty. You might have noticed, Matthew, like a lot of Fridays that have gone by in the previous few weeks on a lot of Fridays, initially the stock market falls. And you know why? Because like the Supreme Court, this case is pending with the Supreme Court. And every Friday, it's anticipated that there would be a decision on this. And like when the Supreme Court comes out to say that this case would not be decided today, that's when the stock market reacts positively and it starts going up. But like whenever this case is like this, the anticipation of this case is around, the stock market starts getting volatile. And now the problem is that we agree like the other things, Trump's tariffs and like whatever and whatnot, like that's happened before. But this thing is pretty crucial because this can bring a lot of uncertainty in the market. Because like if the Supreme Court decides on the legality of tariffs and if it says that the tariffs are not legal, not only would these tariffs be reversed, but there would be a lot of payback that I don't know who would pay back the tariffs that have been like accounted for in the past year.
I mean, that could be it could be like a no downside type of event, actually, right? Because if the market is like, so if you take like the efficient market hypothesis, which basically says that all information out there is reflected in the stock price immediately and accurately, which in itself is probably a fallacy, because but that is a theory in terms of portfolio management and in finance. If the court rules that uh the administration was, offside when they implemented the tariffs, and those need to be reversed, that could be perceived as positive news for the stock market. And if they rule that no, they were onside, if that whatever the administration implemented as tariffs, that they're onside, well, those prices are already baked in.
No, but like, why do you say it would be positive for the stock market?
because because if you reverse the effect of tariffs, everything becomes cheaper.
It becomes cheaper, but like there are a lot of implications
Correct.
because Donald Trump, he's gonna fight this thing first, so it's gonna bring a lot of
Maybe
uncertainty, and the stock
I would
market
see this as
hates.
almost a zero downside decision. But I think it's an interesting. I think the market should rally in theory. Now, don't hold me to it, but that's my position here.
Yeah, so like what I think is like the thing that the stock market hates the most, it's not bad news, it's not anything, it's uncertain. Whenever there's
Uncertainty, correct.
uncertainty, the stock market hates that thing. Okay, so like it's gonna bring a lot of uncertainty, it's gonna bring chaos because Trump is gonna come up with this rhetoric like that thing is not like working for me or we're screwed and like whatever the language that he uses. And I think like it's not gonna bode well for anything because like he's gonna fight this case till the end.
Well,
But
he
like,
only
yeah,
has 3 more years
yeah,
to fight. So, all right, let's move on here.
Okay, so like this graph tells like what's gonna have what are the implications if the EU is gonna get slapped with additional tariffs. So as of now, EU is the biggest trader, I would say, or the US imports the most amount of goods in value terms from the EU. Okay, so like the share of total US imports is around 20.2% from the EU. So like EU is slapped with tariffs, then it's gonna have like big implications both for the US and the EU. Okay,
So it's
so
interesting when you look at these graphs. I think it's important to kind of filter out noise when you're reading the newspaper. Well, whoever reads the newspaper anymore, but like, reading the news, that certainly there's reason to cheer and frown upon news when it comes to the EU. But even China, yes, is in like kind of the top five, but it's number four here, less than 10%, right? So, but of course, we obviously China is a very, very large trading partner, but not even as large as Canada, right? So it's important to kind of calibrate like this. Daniel's slide deck here, I think, does an excellent job of really putting numbers where sometimes we only see qualitative factors that hit the headlines, right? And obviously, we need to identify the source, and the sources are, you know, I would say, like, I would like to think they're all reliable. Census Bureau from the United States. But again, this is data bringing back to our fund performance. This is data that either in like we at the very high level inside the fund, we try to distill things down to whether something is going to increase uncertainty or decrease uncertainty. And we, quite frankly, we want a little bit of both. And the reason being is because we are writing options in the portfolio, we want to have some level of uncertainty because that gives us better option premiums. And if we get assigned, it creates a reasonable chunk of alpha for the fund, right? It's good for the fund, right? However, if we have no uncertainty, then the option writing capabilities they do dry up a little bit, and we are relying, and it's a very good thing to rely on increased asset prices. So we want a little bit of both, but a nice natural balance of the two. Okay, Danielle,
yes,
please.
yeah, I would say like we would prefer the stock market giving us opportunities to like make more money.
Yeah, and that sometimes manifests itself as periods of uncertainty,
Yeah, obviously.
right? And uncertain, like I mean, just to using these kind of like philosophical terms, uncertainty is where the opportunity is, right?
Yeah.
I mean, if so, the way this is structured is that when we see moments of uncertainty, we've done our homework already on all of the holdings we have in the portfolio, in addition to the holdings. Sorry, in addition to, let's just call it, the not the B team, but the people on the bench, right? Certainly not the B team, but the people on the bench, right? Which are companies on the bench. So we are looking at it through that lens. So when we see opportunity and when we see uncertainty, we are seeing opportunity to potentially transact there. Okay.
Yeah, one other thing I wanted to add is like uncertainties sometimes are blessings in disguise. So like what happened last year between February and April, that was a blessing in disguise, both for the stock market and for like everything. Okay, I'll go over the next slide. So right now, what's happening, apart from tariffs that were going to get implemented on the EU, like what I mentioned in the previous slide, on like there was a framework that was agreed between NATO and the US president, but like as per latest news, Trump also threatened to impose 100% tariff on goods imported from Canada if it negotiates a trade deal with China. So, in response, Canada's Prime Minister Mark Carney stated, "We have no intention of doing that with China or any other non market economy. What we have done with China is to rectify some issues that developed in the last couple of years." Do you want to like comment on this, Matthew?
Yeah. So a couple of things here. First of all, it's a testament to how quickly markets uh, and news progress and expire in this day and age. Uh, you know, Danielle,
Yeah.
like when you drafted this deck and we sent it through compliance, because that's what we have to do when we're publicly discussing something, right? We Greenland was an issue, right? and all sorts of speculation was flying around. Sovereignty, legality, tariffs, military, purchase price. Like, my God, you anywhere you look. And let me ask you this, Danielle. Like today, is Greenland an issue?
No,
No,
I
Greenland's not
don't
an
think
issue.
even Canada is an issue right
And yeah, debatably not even Canada. Canada was a little bit newer. And, factually speaking, Prime Minister Carney did travel to China. I don't know I wasn't there. I don't know exactly what was said. And perhaps Canada's not even an issue now, right? However, when Danielle and I are discussing and analyzing the portfolio, which we do on a daily basis, we need to take this into account to see if there's, levels of uncertainty should not be acted on. Like, as we said before, we want to have some uncertainty, but for those of you, and I think that much of you here who have traded their own accounts with respect to options, you want some uncertainty, but you probably don't want unreasonable levels of uncertainty. We had a time back in COVID where, for by and large, the uncertainty index or the VIX hit about 80%, right? That's a level of uncertainty that traders in the market and many managers in the market, they don't want to deal with that level of uncertainty, right? That's a little too extreme. Now, granted, I think that level of VIX was like literally, I think, a math guy did an analysis, and that was, I think, three standard deviations away from the mean or force. It was like really, really like not even conceivable that would happen, right? So, but then we do have this geopolitical tension, which does have kind of an undercurrent of the economy today and vis-a-vis asset prices. Okay, let's move on to the next couple of slides.
One thing I wanted to say, regardless of the fickle nature of news like this, the lesson still remains that these tariffs and like what happens, you're like I think you have understood the pattern. Like that's the entire motive of this presentation is to understand the pattern, right? Like what happens when these tariffs and whatnot, like when tariffs are instituted, especially by the US, the pattern is still similar. And we were trying to like basically understand the pattern. And it's a similar pattern like what happened last year. Yeah,
All
so
right.
these are the
What are
yeah,
these
this is
squiggly lines, Danielle? Tell us what these squiggly lines are.
these squiggly lines, like what it's telling us is that the S&P may now be, and it's testing its resistance of 7,000 today. Okay. Yeah, that's the upper Bollinger Band. The MACD, that's an indicator that we use. It's showing, and there's another indicator, this parabolic SAR, that's showing us that the S&P may be gearing up for another bull run. And probably with the earnings that came out today, especially Microsoft and Meta, they beat earnings expectation. If you look at the after the post trade stock prices, Microsoft, I don't know, like it fell, but like Meta and Tesla, they're doing really well. So tomorrow, probably you're gonna see this resistance get broken. So like that's what our indicator was taking. And this graph and these lines were drawn like a one or 2 days before this. So like it's gonna test and it's gonna probably break this resistance. Okay.
So another thing here is like, within the portfolio, we are, it's in terms of its principles. Yes, we're writing options. Yes, we have an efficient way of diversifying the portfolio. Yes, we're employing seasonality, but yes, we're also employing fundamental analysis and lastly, technical analysis. We do look at levels like this when we're managing the money inside the portfolio, right? And you can see here that it was a news. It did hit the news that for a brief period, I don't know if it ended up over 7,000, but it did exceed 7,000 today in trading actually, right? And we want to see like sometimes assets have a habit of hitting a resistance point and lingering around there for a certain period and creating a new base, right? And that happens a lot. And you can see that actually a little bit in this graph. Actually around the points, it's a little small for me, but like around the August, September, October kind of time frame, mostly around August and September, you see, it's not really doing too much, a little bit down, a little bit up, a little bit up and down, and then, you kind of it reset itself, the market reset itself and made its way higher into the end of the year now into 2026. Okay, let's move on to the next slide.
Yeah, so the next chart of the Nasdaq is showing a similar pattern, like what the S&P is like um showing us to do, like what it's indicating. I think Nasdaq is also indicating the same thing. Like both are gearing up for a bull run, and there's a resistance level of 26,000. I think probably it's being tested right now. And like tomorrow, because the earnings came out good, and the Fed, the FOMC was like the rate, policy rate was stable at 3.75%. So probably tomorrow, and in the next couple of days, it's going to test and probably break this resistance at this upper Bollinger Band. Because like all the indicators right now are showing that the stock market is gearing up for a bull.
So
Okay.
I'd like to bring your attention to a couple of things here. Like, look how many times this level of 26,000
Yeah.
has been tested. Like, going back to November, maybe again in November, beginning December, halfway through December, and now, towards the end of December, and now pretty much hovering around just below that mark, several times in January, right? And, we can see if we have a positive earnings season, right? Meaning strong earnings, companies continue to display strong fundamentals. Do we exceed that boundary? And does our point of resistance then turn into a point of support? And sometimes that actually does happen. And you can see that happening back in August and September, right? Around that 25, sorry, Danielle, this is a little small for me. I think it's like 25, 125 around there, the green box, like there. Yeah, 25, 125. You can see in August and September, it is kind of bouncing off of, like, bouncing back below that line there. And indeed, after it surpassed that level, and that same point of resistance at 25 125 became a level of support, and we see that support pretty much hit there, I'd say, at least three times before the end of the year, right? So there is a pattern to this, and we are kind of monitoring this as we are managing the portfolio.
Yeah, one thing
Okay,
I wanted to like just like emphasize is like to your point that it was testing these resistance levels before as well. The thing is like it was testing, but there was not a catalyst to make it break this resistance level. Now there's a catalyst in place, that's these earnings. So that's why there's a high likelihood that this resistance level might be broken finally. Okay, so now the next is like our like what are we doing in terms
so
of
what does
like our
this all mean to our portfolio, and like how are we constructed it? That's really how we like to structure these conversations. So, like, we continue, we have our 15 odd holdings here, guys. And we continue to monitor them. They are all at or near the desired exposure, with the exception of a couple. Micron Technology, that's a new addition to the fund. We saw microtechnology, and generally speaking, it's is it still within the semiconductor space and the technology space? Yes, but it is they are in a slightly different market, and we saw an awfully low price multiple on this stock, and it has shot up ever since, and we are trying to get some allocation to it, but it is doing very well, and we want to get as best a price as possible. So, our target allocation there is about 4%. We're sitting at about 1.6 right now. Same goes with Broadcom. We started getting exposure to Broadcom probably in the fall of 2025, and we're slowly inching our way into this. When you're dealing with this on a professional level, you don't want to say, well, I need 5% Broadcom and this simply go buy 5%. We have to leg into this, prudently, and to the best of our capability. Mainstays are still the Nvidias of the world, specifically Nvidia, and also Meta and Tesla, right? Tesla sitting at the highest. We're in the process of managing that position rather carefully, because we would like to get that number down to around the 10% mark, but we're going to be very, prudent in how we get there, right? Tesla had mixed earnings. I want to see what happens tomorrow. I simply haven't had time to see how it went after the bell. But yeah, we'll see how that acts. And we would like to get that down to 10. and that's really the setup of our portfolio here. We like this. We do like the strength of some of these. Actually, no, we like the strength of all of these names, and we are particularly comfortable with certain of these stocks that are used as kind of a softening in terms of a downturn, and also some of these stocks which have the horsepower to really propel the fund forward. And we certainly saw this last year in terms of performance. Okay. All right, let's go to the next page, please. So in a summary, we have about 97% of our cash allocated to that. That's changing day over day. We do have obviously some written puts. We are Canadian. Now this has actually changed a little bit. I think now we're beating the index. But when this was posted on January 26th, we were this shy of the index by, what is that, 53 basis points, and I think we're beating the index by, I think, 50 or 60 basis points now. So again, that changes. Of course, we're in month 1 of 12, guys. The clock is reset. And we start this again in terms of our performance versus the index, and we're hoping that our investment theses and the playbook of the companies we are invested in continues to kind of roll out as planned, right? Interesting one here. Total value of option premiums received as a percentage of AUM, 7.7%. That's a good chunk of change there. Options premiums, they do add alpha to the portfolio. So does portfolio tilting and the underlying stock selection. Okay. Let's continue on here. So guys, this is in the middle of RSP season. Me or some of our sales team, which is, Wasim and Basir, Danielle, we have been or we are reaching out to you in terms of RSP season, and also to update KYCs. We will be contacting you to update KYCs. There's an annual obligation that we do need to get in touch with our clients to update their KYC, simply to see what has, if there's anything in your life that has changed that may have an impact on, how you're viewing risk and how you're viewing return, and, where your preferences are. So we are going to be having a call with you regarding updating your KYCs, and see if you are interested in putting any more money into this fund during RSP season. The first 60 days of the following year count towards last year's contribution limit, and that comes to the end of February. Okay, so if you have any questions, please let any of us know. Danielle, the next slide, please. So here, what to look out for. So this is important because we'll be speaking again to you guys next month, and please tune in. Even this presentation, it will be on our YouTube channel, hopefully in the next few days. But from seasonality perspective, Feb is a little bit sluggish, but you know what? We're going to be heading into the end of earnings season into February as well. So, maybe that plays the point. Seasonality, I do believe in it to a certain extent. Daniel will say he doesn't believe in it at all. I believe in it somewhat. It does play a part. However, yeah, I think it's important to note that it could be a little softness from the season perspective, but I think that's going to be outweighed by the geopolitical, by which I mean tariffs primarily, and the macroeconomic environment. This tug of war between the administration, the FOMC, and also the new FOMC chair that's supposed to be coming in, Warsh, I think his name is, right? I think he's in the pole position there come June, right? So I think those are going to supersede any seasonality play we have there. And yeah, that's what we're looking for. Now just as last year, I should say also, this is the first Theta Alpha Fund update call we've had in 2026. So, as a recap, last year we did, in my opinion, exceptionally well. Our return in Canadian dollars came in at about 20%. The NASDAQ, which is a benchmark, came in at about 14 or 15%. And we beat the NASDAQ by about 4.85% after fees. So we did actually very well. We're very proud of that. That's not obviously a guarantee that we do that every single year, but my goodness, we are going to, on a risk adjusted basis, using as prudent decisions as possible, try and replicate that performance. But we have to see where the cards land, because obviously, no one can beat the index every single year. That's obviously not possible. But like, we did have a very good year last year, and many thanks also to our investment team, as this is a team effort. And there are many thanks that are owed to Danielle and to Omar. I'm not going to thank myself, because that seems inappropriate if I thank myself. But yeah, so many thanks to Danielle, who is our analyst and portfolio manager in the fund, and also Omar, who's absent today. Okay, let's move on. Is there another page here? Yes. So here, when this is what number caught me by surprise here is February, right? So if you look at here, this is the S&P, and I know our benchmark is the Nasdaq, but fair enough. We use the S&P here. It's a broad-based index. It's over the last 20 years, it's been down 10 basis points, or negative 0.1%. Okay, but in the same graph, it's like, well, it's positive 55% of the time. And that might sound counterintuitive. And the reason it is because if you look at 2019, it was down 11%. And in 2019, what did we have? We had the end of, was that 2009? 2009 or 2019? Maybe going blind. I think
Which
it's
one?
2009, right?
2009. Like the minimum was
2009. Okay.
like
So maybe it's about time Matthew gets some reading glasses, but that's maybe this is too small. Maybe it's too small. Yeah. That was at the end of the financial crisis, right? So
yeah.
so yeah, so that certainly is an outlier, but again, most of the time, 55%, it actually produces 55% there is a gain, right? And if you look here, like, yeah, there's a gain in March and in April, May. Like, oftentimes there's again that concept of seasonality and the summer months being weak. It's going away a little bit, right? It is going away a little bit, because don't forget, 20 years, that takes us back to 2006 now, right? 20 years ago is no longer in the 1990s, right? And the stock market does evolve. Okay, let's continue on.
One sec.
All right, guys, this is if you do have any questions or comments or concerns, you can reach me there at my phone number and my email. That's my direct line, along with David Jarvis of Quarton Capital. You can obviously reach out to Danielle as well. And if you have any questions or concerns, please let us know. And the last slide is our disclaimer that we need to kind of put on the presentation. Everyone should read this and digest it as you will. And we'll leave this on for a few moments. And that's the end of the presentation. If you do have any questions, please put them in the chat box. We'll get back to you. And if you don't, you can feel free to contact us privately if you wish, and ask us any questions. And we thank you so much for your time. And we thank you so much for your support in the Theta Alpha Fund. Thank you very much.
Thank you.